Good morning, everyone. This is Jonathan Pollard of Pollard Financial Coaching and Gen Y Financial Freedom coming to you this November 11th, 2014. And today's topic is about life insurance and why you need it if you have children and the upsides and downsides of different types of life insurance. So without further ado, let's jump right in. Before I get into the specifics of different types of life insurance, I just want to say a little bit about my personal philosophy on building wealth and investing. I think that the best offense is defense. So by that I mean, in order to build wealth, you have to protect yourself on the downside. You have to insure against catastrophic events, wiping out your wealth, preventing you from leaving a legacy. You want to stay away from things that will destroy money or destroy your ability to get ahead. Insurance is one of those things because it replaces your income in the event of your death for your dependents. So if you have children, if you have a spouse, you have someone who's reliant on your income. But if you die, that income that you bring into the household is no longer there. So that's the purpose of getting life insurance. When you die, you don't want your parents, you don't want your family, your wife, your husband, your children worrying about how to pay for your funeral bills, how you're going to be buried. And you also want your children and your spouse, your husband or your wife, to be able to go on living a comfortable life, even though you're not around to provide for him or her. So that's one of the main reasons to get life insurance. There are three main types of life insurance that you might have heard of. The first one is called term life insurance. The second one is called whole life insurance. And the third one, and the least important one, because it's the least applicable to most people, is universal life insurance. So with regard to term life insurance, it's somewhat self-explanatory. Term life insurance lasts for a specified period of time, usually 10, 20, 30 years. And at the end of that time period that you get the term life insurance for, whether 10, 20, or 30 years, if you don't die within those 10, 20, or 30 years, then the policy is obsolete, is null and void. It has no value. Okay? Because term life insurance is for a specified period of time, 10, 20, or 30 years, it usually has a lower premium. It usually has a lower monthly amount that you are required to pay in order to get that insurance protection. One of the downsides of term life insurance is that even though it's inexpensive, it does not build up a cash value, meaning that, as I said before, if you do not die within that specified time period, then the policy is worth zero one day after the term expires. With regard to whole life insurance is more expensive than term life insurance. However, it has multiple benefits. Those benefits are that it accrues a cash value. So when you are paying for that life insurance coverage, each premium that you pay each month goes into a bank essentially, and it accrues interest for you. And when an insurance company makes money over and above the amount that it's had to pay out, it usually pays out that surplus money in the form of dividends to the policyholders, right? So if you have a whole life insurance policy, you can also usually collect dividends on that policy in addition to accruing a cash value, which is somewhat like forced saving on you because you pay a premium every month and it just sits somewhere building up, just like putting money in a bank. Those dividends that you get from the life insurance policy, they are taxable, but you can either take them in cash or you can use them to pay off future premiums that you owe on that life insurance policy. And you can buy even more insurance, right? So whole life insurance is really flexible. The third and the last type of life insurance is universal life insurance. And that's basically life insurance where the premium that you pay every month gets invested in some sort of interest rate sensitive asset, whether that be the stock market or the bond market or a basket of commodities such as gold or oil. Universal life insurance is usually not needed for most people. It's not applicable to most people's lives unless they're a very, very sophisticated investor. I personally recommend that people get a 20-year term life insurance policy that is convertible to whole life, especially if they're in their early 30s or late 20s. I recommend that they get that type of policy, a term life insurance policy that's convertible to whole. And the reason for that is that your premiums when you're starting out as a young person in your late 20s or early 30s will be much lower than if you started out with a whole life policy. But as your salary grows, as is expected to grow as you progress on in your career, you can afford to pay those higher whole life premiums, whole life insurance premiums that are required of you. And the last thing I want to say is that in order to calculate how much insurance you need, you should definitely consult with an insurance broker. But usually the rule of thumb is you subtract your age from 70, which is the assumed age at which you will retire, and you multiply that number, multiply that difference by your current salary. So let's say you are 30 years old and you make $40,000 a year. 70 minus 30 is 40 years. All right, and so you multiply that by your current salary, which is $40,000 a year. 40 times 40,000 is 1.6 million. So you should have about $1 to $2 million in life insurance, and the reason for that is that that's the economic value of your life to your family. Okay, I hope this was very informative for all of you guys, and if you have any questions, as always, please feel free to email me at jcp182000@yahoo.com. Thanks a lot and stay tuned.